Welcome to vTalkInsight, Market Drivers Daily for January 20th, 2026. Transatlantic tariff threats, a sharp rotation into safe havens, and accelerating AI productivity gains are all colliding in markets right now, reshaping risk, returns, and dispersion across assets. Geopolitics has shifted from a background risk to the main storyline as U.S. and European trade tensions intensify again. Markets are starting to treat the prospect of a transatlantic tariff confrontation as a real macro shock, rather than just noise. The United States is preparing to levy new duties on 8 European countries, starting with 10% tariffs from the 1st of February and potentially stepping up to 25% by June. That timetable concentrates risk for export-heavy European markets, especially autos, luxury goods, and high-end manufacturers with large U.S. revenue shares. On the other side, European leaders are moving from rhetoric to concrete contingency plans, including possible retaliation on close to $100 billion worth of U.S. goods if talks fail. The dispute over U.S. ambitions in Greenland is feeding into a broader reassessment of the relationship, with protests in Denmark and Greenland, talk of Canadian troop deployments, and NATO cohesion in the Arctic all in a mix. European policymakers are being pushed to provide stability as firms face rising tariffs and heavier debt loads on their U.S. operations, squeezing cash flows and complicating planning. Business leaders report that trade uncertainty is freezing long-term investment decisions, with many expecting tariff volatility to persist through 2026 and to pass on higher costs to consumers, which could prove mildly inflationary. These tensions are also feeding into capital flow and currency conversations. European governments hold several trillion dollars of U.S. assets and may weigh whether concentrated exposure still makes sense if policy risk stays elevated, while foreign investors with large, often unhedged, U.S. positions are reconsidering their currency hedging. The dollar is already softened against major peers, and the euro has strengthened, although past tariff episodes suggest that euro strength can reverse quickly as relative growth and bargaining power shift. There's a counter-argument that politics may stop short of a full-scale trade war, as both sides have limited appetite for self-inflicted damage and Europe has less leverage than China in prior disputes. That view is echoed by the absence of an aggressive rally in core government bonds, which indicates that markets do not yet see this as a systemic shock. Still, recent experience shows that low-probability, high-impact geopolitical events are hard to price and can move quickly. Key watch points now are whether U.S. tariffs actually activate on the 1st of February at the announced levels, how far EU retaliation goes, and how sector and regional performance gaps evolve as this plays out. The market response to these tensions is clearly risk-off, but the pattern of safe haven demand is not the classic playbook. Equity futures in both the U.S. and Europe are sharply lower, yet the strongest hedging activity is not in government bonds, but in commodities, currencies, and defensive equity pockets. Gold and silver are seeing pronounced inflows as global equities retreat, with investors leaning on precious metals as a straightforward hedge against geopolitical shocks and policy surprises. That demand is also visible in equity space, where miners and gold-linked UK names are holding up better than the broader market. In foreign exchange, the Swiss franc stands out as a preferred safe haven, benefiting from being relatively insulated from the current tariff rounds. Short-dated German bonds and the franc are attracting flows, while the dollar index is drifting lower, reflecting an incremental risk premium on U.S. assets and some repositioning of hedges by global investors. Within European equities, the search for resilience is driving a distinct sector rotation. Defense stocks are outperforming on expectations of higher regional defense, spending, and greater NATO presence. Utilities and select grocery retailers are comparatively steady, while banks, technology, and consumer names are bearing the brunt of risk aversion. There is also a slower-moving, structural version of the safety trade playing out in reserves and capital flows. Central banks are gradually diversifying away from exclusive reliance on the dollar, increasing gold holdings and showing some interest in Bitcoin, in part reacting to previous episodes of geopolitical asset freezes and domestic inflation stress. European governments, as large holders of U.S. securities, and foreign investors with big, unhedged U.S. exposures, may reassess allocations if policy uncertainty persists, which would add to the political risk premium on U.S. markets. The counterpoint is that this safety rotation could reverse quickly if trade tensions are defused or tariffs are watered down in implementation. The lack of an aggressive rally in core sovereign bonds suggests investors still see this more as a volatility shock than an imminent growth or credit event. From here, the focus is likely to stay on how persistent demand for gold and the Swiss franc proves to be, whether bond markets start to confirm or contradict the risk narrative, and how these hedging patterns interact with the next theme driving dispersion, namely the AI-led shifts in productivity and sector leadership. Against this noisy geopolitical backdrop, artificial intelligence remains a key anchor for the medium-term macro story. Recent figures point to U.S. productivity growth moving from roughly 1% to close to 2%, with AI and automation cited as important contributors, and that is shaping expectations for future earnings and growth resilience. A near doubling in productivity growth has powerful implications if it proves durable, because it can support margins and wage growth at the same time, but the benefits are unlikely to be evenly distributed. Companies and sectors that manage to embed AI into processes and decision-making are positioned very differently from those that lag, which points to wider dispersion within equity and credit markets. That dispersion is one reason why volatility is expected to remain elevated, not just from geopolitics and policy surprises, but also from AI-driven shifts in sector leadership. As markets reassess who the genuine AI beneficiaries are, valuations and earnings expectations can adjust quickly, creating both upside and downside surprises across technology, financials, and service industries. In market structure, large institutions are already experimenting with the next wave of AI-enabled tools. HSBC, for example, is investing in quantum computing and advanced AI to improve trading efficiency and accuracy, including pilots in bond markets, with the expectation that these technologies could ultimately transform execution and risk management across asset classes. Importantly, not all of this transformation is framed around headcount cuts. Despite significant spending on automation and AI, HSBC signals an intention to keep bringing in new talent and to redeploy existing staff into higher value, client-facing roles, suggesting a model where technology augments people rather than simply replacing them. The counterview is that many firms may struggle to translate AI investments into real productivity gains, and earlier in the month we highlighted how infrastructure constraints can also slow rollouts. That means outcomes are likely to be highly uneven, with clear winners and losers rather than a uniform uplift. For markets, the key questions now are how fast reported productivity continues to improve, how widely real-world use cases like AI and quantum-assisted trading spread beyond early adopters, and how this structural optimism around technology interacts with the cyclical uncertainty created by today's trade and geopolitical tensions. To wrap up, transatlantic trade tensions are moving from tail risk to central driver, putting European exporters and capital flows under scrutiny, while the safety trade is clustering in gold, the Swiss franc, and defensive sectors rather than in a classic rush to government bonds. At the same time, AI and quantum technologies are quietly lifting productivity and reshaping trading, reinforcing a regime of higher dispersion and persistent volatility where macro shocks and structural shifts collide. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.